For instance, I just looked at the screen a while ago, and the big blue chip of the gold miners is, of course, Newmont. And it has, over the years, either outperformed or underperformed the mining sector. But lately, it is really zooming. Like it's up, huge in the last few months. I think there's money moving out of the stock market sector, being reallocated by large asset managers to get a foothold into the gold mining sector. And Newmont had an earnings report a week or so ago that demonstrated, hey, we're making good money, folks. And suddenly there's great demand for Newmont, and that indicates to me, if they're buying large blue chips, it's probably large asset managers primarily,
right.
Not so much your small investors. But anyway, those two pieces of the puzzle, the stock market topping out, ultimately therefore flushing money out of that category into the alternative. And the only alternative that's viable lately has been gold and related. The markets, to some extent, impact each other. Okay, you don't just look at gold and say, what's gold doing? Well, what's the stock market doing? What are bonds doing? What's dollar index doing, et cetera? So all these things are important to look at. The stock market. In January, we put out a sell recommendation on the S&P based on long-term momentum trend breakage, meaning be gone. Leave it as an investment asset. Go away. And we had a sharp drop into April. Problem was it was news related, and those are the worst kind of drops because quite often you want a drop that nobody can quite figure out why. Okay, that's the best kind. But anyway, so we had a news related, and we predicted, where you've got a circle there, in fact, on that chart, we predicted there would be a bounce point there at 4,800, well before it ever got down there. And sure enough, they bounced at 48.35 and continued to bounce and went up and made a new high, new marginal high. We're talking several percentage points above the high we saw in January, that first upper circle. Okay.
Looking back at market peaks in 2000 and 2007, we see eerily similar patterns unfolding now. Initial declines were followed by marginal highs, tricking investors into complacency before prolonged sell-offs. These weren't crashes. They were slow, grinding declines that wiped out 50-80% of tech-heavy indices. In late 2024 and early 2025, momentum indicators signaled a shift as investors quietly exited key sectors. By mid-2025, price action once again began rolling over. The broader market remains disconnected from the headline indices, raising red flags. The question isn't if history will rhyme, it's whether investors will recognize the rhythm in time.
Now, this process where momentum breaks something serious and long-term occurred in 2000, in January of 2000 at the dot-com top. We had a drop into February, but then in March of 2000, it went back up and made a new high, okay? So a lot of our subscribers said, oh boy, you were wrong. And well, it didn't go anywhere. It made a new high and just sort of squatted. Wasted the year 2000, up and down, either side of our be gone signal. Finally, in 2001, it started to fall apart, okay? And you never crashed or anything like that. You just had a bloody decline, 50% S&P, and for the NASDAQ 100, an 82% drop, wipeout. Okay. 2007 was a similar arduous top where, when you made your high, it didn't just make a high and collapse or anything like that. It made a high, went down, made a marginal new high with a Fed rate cut, by the way. And that circle there, there's about a year of twisting and turning, with action marginally above the 2000 high. So if you're a price guy and you drew a line across the 2000 high, in October of 2007, you said, oh, wow, a major breakout. Okay, well, it was baloney, okay? Because long-term momentum had already said no good, okay? Finally, it started to come apart, okay? Took it a while. We've got the similar type of arduous year-wide type pattern now, where we had distribution. In other words, somebody's said in 2024, the latter part of that year, and into early 2025, I want out. And therefore you plateaued for quite a few months, had your drop into April, then came up and you've now made a, quote, new high. Now, by the way, when you really examine, quote, the market, not just S&P or NASDAQ 100. There's quite a few sectors, quite a few symbols, including most of the Mag 7, are not making new highs. Microsoft and NVIDIA have,
right,
and Meta, but the other 7, they're not making new highs.
Yeah, more like S&P 7, right?
Yeah, it's now the Mag 3 or Mag 2. Okay, so just as the Magnificent 7 has dwindled in terms of leadership, so has the market itself. When you examine certain sectors, you'll see, hey, they're not making new highs. You know, what's going on here? I hear this new high stuff. It's very limited, very narrow. Okay.
Contrary to popular belief, gold often diverges from equities. From January to April 2025, the S&P declined sharply while gold surged. When equities bounced back, gold didn't falter, it went sideways. This unexpected stability suggested hidden strength. Sellers were met with equal demand, keeping gold afloat. During the same period, silver gained 13% and gold miners like Newmont posted double-digit returns. These shifts hint at institutional reallocations away from stocks and into hard assets. The recent quiet behavior of gold isn't a sign of weakness, it's a base. And while gold consolidates, silver and miners are already on the move.
What happened last week on the close was sufficient weakness on the part of the S&P and the NASDAQ and a lot of other sectors within the market to indicate to us that there's a good chance the high you just saw prior week was it. And probably you're going to start now to sink back down. See, you're rallying today up into that gap you left on Friday. But if that high basically was it and you did enough damage into the end of the week to indicate to us that this, quote, new high is in question. And once you get price action back below the price highs we saw in January, which is in the 6,100 zone, okay? Then suddenly the guys who think this price breakout was valid will say, hey, you know, how come we're back below the old high? So that's what we're looking for right now. But it's interesting to note that, you know, there's a widespread assumption that if the stock market goes down hard, gold will go down hard too, right? You know, everybody says that. Well, look at January through April on S&P, and then look at January through April on gold. Total opposites. Gold went vertical, stock market went down. And then when the stock market decided to have its recoup and come back up to and through the highs, you would think, well, gold will sell off then if it's opposite the S&P. It didn't. Instead, it went sideways.
Right.
Totally comatose, but steady. In other words, yeah, there were sellers up there, but the sellers couldn't get anything going on the downside. Why? Because the demand was underneath it. And
so you've got the gold price here in blue, right?
Yeah.
Like you said, there's a big divergence between the two.
Yeah. And so instead of breaking down when the stock market recouped, because we argue they're opposites, gold held well. But also during that time from April to the present, while gold has gone lateral, silver's gone up 13% since its April close. And the gold miners have gone up significantly too since the April close, meaning that while gold has gone to sleep for the past 4 months, it is starting to firm again right now as we speak. It's back to 3,400. The miners in silver have risen nicely, double digits for silver, in fact. So this is what we thought would likely happen here, is that we'd enter an acceleration phase where the prior laggards within the monetary complex, silver and the gold and silver miners, would suddenly come to the forefront and leave the mama market behind. In other words, gold's going to continue to rise in our view, probably even more sharply than it has. But at this point forward, expect silver and the miners to beat gold on a percentage basis.
Yeah, so I have gold here in yellow, silver here in gray, and then the silver miners here in purple.
Since the April close, if you do the math, it's silver's up 13% today versus its April monthly close, and gold is up a couple percent versus its April monthly close. So there's been a shift there. While things seem to be getting sold into as far as gold, but not breaking down, silver and the miners moved up. Now, how come?
Large asset managers appear to be shifting capital into gold and silver miners. Newmont's strong earnings underscored the sector's renewed profitability, igniting investor interest. Since April 2025, silver has outpaced gold, and miners are outperforming both. This signals the start of a new leadership trend within the monetary metals space. The so-called Magnificent Seven stocks have narrowed down to just a few performing names. As capital exits tech and growth sectors, silver and mining equities stand ready to absorb demand. Gold may remain steady, but silver and miners are poised to accelerate faster, potentially leading the next commodity supercycle.
For instance, I just looked at the screen a while ago, and the big blue chip of the gold miners is, of course, Newmont. And it has, over the years, either outperformed or underperformed the mining sector. But lately, it is really zooming. Like it's up, huge in the last few months. I think there's money moving out of the stock market sector, being reallocated by large asset managers to get a foothold into the gold mining sector. And Newmont had an earnings report a week or so ago that demonstrated, hey, we're making good money, folks. And suddenly there's great demand for Newmont, and that indicates to me, if they're buying large blue chips, it's probably large asset managers primarily,
right?
Not so much your small investors. But anyway, those two pieces of the puzzle, the stock market topping out, ultimately therefore flushing money out of that category into the alternative. And the only alternative that's viable lately has been gold and related. Between now and the year end, we're going to have an enormous up move in the monetary metals, led by silver, led by the gold and silver miners. Gold strong as well, but not on the percent basis as those subsets. And I think at the same time, we're going to see the stock market finally demonstrate to people that what's been going on since late 2024 is really distribution. Yeah, we made a marginal new high now, but by a few percent, and that's very narrow. The broad market didn't do that. Look at small caps, IWM, for example, the Russell 2000 ETF. Nowhere are they close to making new highs. Look at their highs back in January. Okay, you can see that. Also, distribution in that category since 2021. I want out. Okay.
Beyond tech, most sectors are struggling. Healthcare XLV, which makes up about 11% of the S&P 500, broke out in early 2024, only to fall back below its previous highs. Small caps like the Russell 2000 IWM have failed to make new highs since 2021. These patterns of false breakouts and quick reversals suggest years of distribution rather than accumulation. While headlines cheer new index highs, the reality is far more fragile. Momentum has turned negative across multiple sectors and cracks are forming. If the market drops below January's key levels, investor confidence may quickly unravel, triggering a broader pullback.
Punch up another one, XLV. It's the healthcare sector. It's like, I think, 10 or 11% of the S&P, if I'm not mistaken. There was distribution in 23, 2021, 2022, 2023. Finally, in 2024, it made a new high, marginally above the 2021 to 2023 highs, and now is sinking back down, especially if you look at it on a monthly basis, you'll see. But right now we've penetrated back, this is monthly going back years here, below the highs that prevailed in 2021, 2022. So that what used to be a ceiling, they broke through, but it aborted. In other words, the rocket liftoff didn't take off. It aborted back below. And I suspect you're going to start to see panic there once you go through those lows we saw in 2022. But this action really has been naught since 2022, late 2021. If you own healthcare, you're not making any money. So there's no making money here. And there's other sectors that reflect this. But anyway, the point being that we don't trust the new stock market high that was made by a narrow select group of indexes and a few sectors. And we think once it rolls over again enough to convince the price guys, momentum's already convinced it's no good. Okay. Price is the one that people look at. And when you roll over enough, like get back below those highs we saw in January, and people start scratching their heads saying, well, I thought. And suddenly some of them realize more and more that hey, something's going on here. Somebody's dumping into the stock market since late 2024, and it's not going anywhere. Meanwhile, gold has been advancing solidly since then, and et cetera, et cetera.
As stocks show signs of topping, gold is preparing for a powerful move. Historical gold peaks, like 2011, came with sharp reversals. Today's persistent retests of highs suggest the opposite, a launchpad, not a top. Meanwhile, global central banks continue to pump liquidity. The M2 money supply hit a new all-time high in 2025, despite no formal rate cuts. This quiet monetary expansion is the real fuel behind gold's strength. Over the past 25 years, gold has outperformed the S&P threefold. If current trends hold, monetary metals, especially silver and miners, could see explosive gains before year's end.
Anyway, that's, I think, watch those two categories, because the stock market does roll over more. That's going to help fuel gold even more so. And also, we know it's going to spark the central banks into doing that which they do best, which is to, further help destroy the money unit by quantifying it more and cutting interest rates as well, as the president has demanded.
Well, they have hit a new all-time high in M2 money supply.
Oh, yeah. No, the money supply is back in gear again. You look at rates for one thing, but when you look at M2, there you go. Over the last 9-10 months, it's accelerated again. So something's been going on there. No, not rate cuts, but money growth. So that's the real factor that drives gold ultimately decade to decade, is the ongoing decay in the money supply. In fact, if you go back 25 years arbitrarily and go to summer of 2000, 25 years ago, July close to July close, gold's up 11-fold and the S&P's up 3.3-fold. So, which one's done better versus the decay in the money unit? Okay.
Yeah.
There's no debate. In fact, the growth in the money supply is outpaced the growth in the S&P. So anyway, that's what's going on, and I think it's going to accelerate. And gold never tops with that type of pattern. When gold tops, it makes a top. I mean, it spikes, it implodes to some extent, but it can't get back up to its high again. 2011, for example, or the low in 2015. Once you made your pivotal peak or low, you didn't go back there again.
Yeah.
You made attempts, but you just couldn't do it. Well, to keep coming back to the same level repeatedly, as we've done over the last now 5 months on gold, that's not a top. That's a launch pad.
Interesting.
And the silver and gold, silver and the gold and silver miners aren't waiting. They've already started to move up out of that.